Good afternoon, everybody. I'm Dan Hussey from Zaner Ag Hedge, bringing you our Strategy of the Week update here for May 19th, 2022. Um, Remember, trading futures involves risk and is not suitable for all investors. Everything I talk about here today is just my own opinion and not a direct trade recommendation. And with that being said, soybeans today being our big breadwinner, up 27 and three quarter cents there in the July, up 15 cents in the November. Corn lagging a bit, kind of unable to make up its mind. I think dependent of whether it wants to follow our wheat markets or the soybeans at this time. And of course, wheat, generally speaking, still I think somewhat bullish. The pullback we're seeing is mainly just a retracement from new contract highs, no matter what July contract you look at there. Certainly has further down the rabbit hole to fall if it wants to, but we'll take a look at that in just a little bit. I wanted to begin today. We're going to begin with corn. We'll come to soybeans and then finish with wheat. Maybe throw a little cattle in there and some of the spreads if we have time. But I really wanted to focus today on, I think, the mentality that we should be having at this time of year with all the news that we know. For starters, I believe corn over the last week or so, the selling pressure, the lack of follow through, the fact that we're kind of sideways here at highs in July, certainly a little more pressure there on December. But December is well off of lows from earlier this month, and certainly has still, I think, remains entrenched in a pretty solid uptrend here, all things considered. This last few days of selling pressure, I think, have come on the back of, the realization that we're going to get upwards of 95% of our corn acres and probably closer to 100, given the weather we've seen over the last week and the anticipation of that planting progress report coming out this next Monday. I think this one we're going to see the biggest jump in those acres. I think the market is going to have constituted the completion of a planting there for corn across the United States. But that doesn't necessarily ring a bearish tone to me. Because after that news has dissipated in the markets and we've priced it in, we're left with a bunch of acres planted and now exposed to the weather conditions for what should be a high probability for a La Nina year, hot, dry conditions this summer, heat dome-like conditions that could affect our crops. If it's anything like last year, we do not have any room for error given the late start to the season we've already had. The acres don't have the amount of time we need to really finish the crop and feel comfortable with that. And again, any weather effects that occur over the next couple months are just going to be exacerbating the issue that we already have. So that's just the domestic situation for corn, wheat, or beans. When you take a look at the international front, things don't get much better. South American production, Brazilian production specifically for the second crop corn has been lowered about 5 million metric tons. Next year, fertilizer prices remain where they're at. There really isn't much hope so far for fertilizer making its way into the hands of South American producers right now. It seems to me that next year's crop is already being threatened by the fact that you just cannot afford to plant it with the input costs associated with those acres. That and all production from South America will probably go and turn towards their domestic markets. Ethanol is a major product in Brazil used to try to alleviate prices at the pump. And there's no reason that their domestic feed demand isn't going to come first before China. And especially in a year and in an inflationary environment where the South American farmer is routinely and habitually uses beans stored in the bin as a means of an hedge against inflation. If you move those assets out, sell them, and you take reals into your bank account, those reals are always going lower in value and just exacerbates the issue that you have in terms of your purchasing power for importing everything you need to put those corn in the ground. So it's sometimes best just to sit on the kernels themselves. Okay, that all being said, shift your sights towards Asia. Chinese domestic production's never good. They can't rely on that. Never have, never will. Repeat, never will. India is now becoming a net importer of of agricultural products, which for the last 2 years has been 4 years really has been a major dynamic shift in the agricultural world that I do not think we are ready or braced for another billion people that are reliant on an outside food source. That to me is one of the scariest things and news events of 2022 so far, is that India doesn't want to export wheat. Yes, they probably will. There's a price that's going to there is a price out there where people will let go of it and certainly walk back on those ideas. But um, global food scarcity right now is not exactly a reason to be bearish any of our row crops. Now, turn your sights towards Europe. Okay, we're getting decent, I guess, weather through France and what have you, but that's a microcosm on the grand scale of things. Ukraine has almost no hope, in my opinion, to get a crop out of the field this year. I think almost all their production is going to be turned domestically or somehow seized by Russian or bought by Russia. I think that there is literally a move here that from Moscow to force Ukraine's production into their hands so that they have a bigger bargaining chip. Otherwise, why would Odessa and Mariupol have been bombed to oblivion and the port infrastructure there have been decimated? That's Ukraine's means to get their product to market, the global market. And without such, there's no way that their rail lines, which are going to be committed to energy products like natural gas and oil, are going to compete with grains. So there's a developing story there that I don't think is getting talked about enough either. All that being said, puts a lot of pressure on the U.S. domestic production and then our export markets here to really hit the ball of the park this year. With the start of a late plant, it makes it silly to think that the highs are completely in for the year. That doesn't mean that we couldn't trade a little lower on the charts. Beginning here with December corn, we have trendline support that would come in around the 55-day moving average, around $7. If we got down there, I would be a welcome buyer for reownership strategies. I don't want to say, I'd sell the farm to buy all the corn, but that's a big level, that $7 psychological threshold that I don't think we have the type of environment that will go below. In the near term, though, we basically have broken back above that 18-day moving average. That's one of our short-term trend following moving averages we follow. Today we did settle and close below it, but after a decent reversal on the day, and we'll look at here in a minute how this pullback may have just been, 2 steps forward, 1 step back in the start of an otherwise, this next leg and trend higher for corn. We're not neither overbought or oversold conditions here on the daily chart. So stochastically, we can go either way, which is why down to 7 or up to 780 is still on the docket. But if you look at this from a monthly, weekly, and even a daily standpoint, with the exception of the last 3 days, we are making a lot of progress higher. This does not look like a market that has topped to me. That can all change. We get perfect weather from now through, tasseling and through the dog days of summer, so to speak, in June and or July and August aren't that hot and heavy. This market, could continue to fall, but we run the risk of the opposite being true, and weather premiums and other things continuing to be forced in. Acreage wise, I think we've done the damage on the chart it wanted to. Okay, maybe it's not enough to break us out towards $8, but it certainly hasn't been enough to break us below $7.20 here today, or even below $7 over the last couple weeks. So 100-day moving average down around 644, 200-day down around 587. Looks like a market that's still entrenched in an uptrend to me. July corn finished positive on the day, a much nicer reversal, getting back above its old trend line that, I think we just saw a bear trap on these charts. We just broke below this trend line drawn from the February low through that low in March. We went below it for, basically to run some stops today. Close back above it, and we have the 18-day moving average up around 794. That's the regression to the mean that I would be looking for. And that's, again, the test of $8, a figure that this market has been fighting to try to stay and break above. But if it doesn't, you got to be willing to accept that corn could have a pullback. Okay, July corn towards $7 is not the end of the world. The 55-day moving average would be broken, but the 100-day at $7 right now is of interest to me. There are also some trend lines here against prior lows sweeping up from much further back on the chart that would come through and probably towards 7 at that time. But for the time being, that's all good. We'd be welcome those areas if we get down there. But look at this. We are basically been oversold on July corn while flagging at highs. I mean, this is technically very bullish. That even in these oversold conditions, the amount of pressure we saw on the market, it has been unable to break below any key figures and has still remained inside of a trading range for the last month or so. So just on that alone, there's absolutely no directional bias you can take from this chart. Other than actually the oversold condition makes me want to be a buyer still. We are broken above the old highs here around 740 to 750. Came back to test them, in my opinion, as support, holding trend line support. 18-day moving average, we get back above that level. I then think the short squeeze on. This looks like a complete bull pennant, and boy, doesn't it just look like this correction we had from February through March. And I'm expecting a leg just like we had out of March up towards the highs in April now to start, and that could take us a little bit higher here. Let's flip over. Let's look at that smaller time frame. I guess since we're on July corn here, let's take a look there. Highs to highs extension. I talked about in last week's video. Supportive area around 770 that came in here. You could also call that a 50% retracement from this $7 area, the old congestion lows, up to its highs there, somewhere around there. That comes in around 760. So we didn't quite make it down there, which is why I'm keeping these levels on the chart. Now the equal legs down from 824 down to 769 here. You extend that equal legs from 810. Okay, that's a 755, 100%. If this is 3 waves down for all of our L8 wave technicians and what have you, there you go. There's a reason we could head down there on the chart and potentially find support just below 760. And there's, like I said, there's a 55-day moving average down there. There's the, trend line. Well, we would be breaking at one trend line, but okay, trend lines are kind of made to be broken sometimes. But these other technicals, like these fibs, are all, aligning down there that if we go there, could be a potential buy. It would be an interesting area to see if support comes into play. And, for, tactical reownership, that's a place to maybe plan for it if you haven't already. With all that being said, though, you take down and start breaking down the smaller time frame, we really are just inside of a range. 50% retracement longs haven't held, 50% retracement shorts haven't held inside this range. And we seem to be holding the low end for the time being, and maybe trading back up towards some levels above us in the near term. So today's price action, we rallied sharply off the lows of the day and during the day session, and then basically just pulled 50% back on the day. So that's 2 steps forward, 1 step back off lows of the day. If that little algorithm or little trend then that's starting from the lows, right? We took 2 steps forward, 1 step back. We then expect 2 steps forward from the 782 area up towards 94. And at that point, I'd want to see it actually kind of get all the way through up towards 97 to $8 for another test. That would break, the full 50% retracement off the prior highs. I'm not necessarily looking for that level to hold, just because, when you take a step back, we have chopped through 50% retracements of this entire range a couple times. What we're looking for are 50% levels that lead into, next in series, holding from here, going to target, then drawing from the low to the next high. And then, now you've got a pattern that's building in the market. And that pattern is the silhouette of some kind of buying algorithm or something, the market participation, whatever you want to call it. It's markets making 2 steps forward, 1 step back, some kind of progress in one direction or the other. Now, cannot deny that off this little high here too, well, the resistance on the day right at 785 was also a little 50% pullback. So you've got to fight over the trend. The 15-minute time frame right now has both sides who have entered at their 50% retracements, and not saying we can't go down to 780, test the 6 to 8 line, and the shorts feel like, oh no, yeah, we got it on the open tonight, and then we scream higher. Yeah, just pointing out that technically speaking, right, markets are kind of cluing in, right? When I start to see reactions from 50% lines, it gets me excited because it's a hint that markets might be attempting to do something. Right? They might be turning on. We might be going from a period of choppy sideways markets where there's not much commitment, we're really in consolidation, to all of a sudden trends being flipped on, like literally a flipping of a switch of trend algorithms versus consolidation algorithms that start to drive market price action in one direction or the other. Is it it's an art form, not a science. So don't, you can't just, hang your hat and assume that that means all is good and we're going higher or lower based off that alone. But again, anytime as a trend trader, anytime I look for something in the market objectively, it's kind of like watching and tracking prey or following footprints in the sand to see where somebody's heading. We don't know if that person that was walking in the sand has continued on their, we don't know where they ended up, let's put it that way, or where they will end up when they finish their journey. However, by following those footsteps in the sand, one in front of the other, we can all of a sudden start to guess. After a while, we can probably start to guess where the next step is going to be, right? And that's the point here, is that we're looking at footprints in the sand. The remnants of something, price action that's happened in the past that hopefully will indicate how the pattern might play out into the future. Over the last several weeks, corn has been locked in a sideways market without much of a trend pattern, but it's the reason I sit here every day drawing these silly lines on charts, because once it starts to come back, once you start to see things, those patterns start to re-exist or what have you, okay, now there might be something more to clue in on, and at some point it might give us the confidence to actually take a trade. 50% retracements in December corn for the month have traded. We went right down to that 6218 line. That is not a great level to have kind of tagged. The fact that we were there for just a moment and bounced off of it is the only reason I'm not just like discounting the fact that the market just traded to a 61.8 line and arguably broke it. But that isn't enough for me to call this a completion, and that, all of a sudden now the 50% off this high absolutely needs to get watched. But it might be, this might be a situation, and we'll look at the calendar spread in a second, where if you're already long July corn, okay, to some capacity, maybe in your reownership strategy, maybe you're long from below, a rally up towards 750 to 760 in December corn, not a terrible short to take and spread out your risk against your July at this point in time. And I wouldn't feel confident in that for one of two reasons. One, anytime we have a break of a 61.8 line like we see here down to a 727 on the chart, I immediately, one rule is I need to draw up the opposing, where the market might bounce to or pull back towards. If this was a 628 line of a short, we'd be drawing where the next ambush long is. Well, there's what we refer to as a potential ambush short here at 746. That doesn't mean that the market is gonna hold there and absolutely head lower. But if I flip over to our July December spread right now, I see a very, very strong reason for this market to have gone down. We were testing 60 cents over. Basically, if we had broken out of 70 cents over, we're going to $1 over, which is a very technically significant inverted level for old crop, new crop. I do think we're going to head back there, but I don't think we're going to get there till like July. And we're going to need weather markets. We're going to need the fear factor of needing it now. And honestly, we're probably going to need crushers and ethanol facilities to admit the fact that, wow, there may not be enough out there for what we need. Hence the purchasing of July, the basis in the front getting just stronger as ever. And honestly, it's the attraction of that grain out of the bins and into the crushers' hands and commercial hands, because they need it now and they're willing to pay for it now. And that's what causes a spread like this to go wildly inverted. We are inverted. We can't break below 30 cents under or over, excuse me. Actually, this entire year has basically been found support between 25 and 31 cents under. We came right back down to test that idea a few days ago. We gapped up on the start of this week, and we have not looked back. We have been bull spreading the corn market for the last week. When you consider what we've been doing the last week in July corn and basically found resistance and have been selling off, something doesn't add up here. We don't typically bull spread in the calendars in a bear market. Okay, the fact that we remained over 30 cents over and we've turned this spread back up again has me believing that we're going to go right back to 60 cents, 70 cents over in the spread, probably break out and be heading towards $1, $1.50. And if that's the case, that means you're going to need to see July corn heading to $8 or $9, while December corn is lagging and maybe just getting to $8. Okay, it's got a long way up. And I think it's, getting December corn above $8 is going to absolutely take July corn going to 9 or 10. But the spread market agrees with us. It's being bull spread. That spread will continue to widen out, and we will see inversion, the panic of not having enough drive the market forces here going forward. And again, need some weather markets, but we've got all the stars aligned for that type of year. All right, so back to December corn here for one last minute. Let's go out here before we move on to the beans, because we've spent enough time here on corn and other things. No, before we go to beans, forget December corn. I actually want to look at some options real quick, because I mentioned on a post earlier today how, a good idea in this environment is some kind of risk reversal strategy. And I just want to show how that kind of breaks down for people, or what that might look like. I'll be working it in two places here. We'll look at some cost or some P&L analysis on it real quick, and then also the actual strikes and what they may be doing. With all that being said, December corn right now trading $7.36. A $7 put went out the day at 50 cents cost to you. I mean, that is extremely expensive, but that would be an amazing floor to have in on December corn right now. I think everyone can agree. If I can afford somehow $7 corn, that is going to give me a good, or having a floor there will give me a good locked in, very likely above all of your costs and what have you for the year. But 50 cents to shell out is just a lot of money. Now you get it; it's protection for 190 days. That's what we're paying for here, because it is only 36 cents out of the money. But outright buying that option, that's one idea. Okay, maybe we're only bearish in the short term, so you can cut down on that cost. Let's go to some short dated options. If for many of our producers, we may not need all the way through that December timeframe. So what I would suggest is looking out to September. If we only need these 99 days of protection, because hey, by September we definitely are going to know what kind of environment we're in. And that $7 put, we may not need that extra 100 days, because by that point we could make some other decisions with our cash. We'll have a very good handle on how many acres we actually brought to production too, and we probably have a very good guess as to what kind of yield we're going to expect out of our field. In other words, our new crop production at come September, late August, early September, we're going to have a pretty decent handle on what kind of year. We're going to know if we're going to make some kind of crop or if it's a disaster, right? And if it's a disaster year, these puts are almost a moot experience, right? If it's been a big production year and everybody's flush with grain at that point, that $7 put by September is probably going to have protected you. Anyway, we can save a few pennies by bringing it into September. So we're going to compare 50 cent cost to buy it outright December. Bringing it into September, it's only about a 38 cent cost here. Okay, we're doing a little bit better. But I suggested in my post a risk reversal strategy. That means we buy a put and we sell a call above. This is a perfect hedging solution for people who have grain in the silo, or you've got storage and you've got it in the bins, or for new crop too, or old crop too, excuse me. But your old crop at this point is now new crop if we're planning on holding it all the way through the end of the year. So unless you are going to, tally it off through the summer, that's a different story. We'll look at those options in a second, but it's the same process, the same idea. You pick a strike that gives you nice protection in the near term. Strikes through July, we can get them a lot higher at a 30-cent cost for a put. Heck, let's just look at them right now. 30, yeah, if you're going to spend that, you're going to have a put that's only 20 cents out of the money here. Actually, no, you can get the at the money puts for July at 30 cents. But we would turn around and finance that by selling a call above, right? So if you're going to spend 20 cents here to get a put for at 765, turn around, sell the 820 call to bring in 15 cents. And now for 5 cents, you've got that put on, and you've at least opened yourself up for another 40 cents of improvement against the board price. I personally like doing this all out through December and in through new crop. And the main reason there is that, again, if you're holding your bushels all the way, if you've got them on storage and you're going to commit to storing them, you could just store them all the way through December. And again, those bushels now become new crop effectively, or the contracts that you can forward them and sell them and you'll deliver against. All right. So anyway, that's $7 put out in December. That's December 23, which actually, you could get, start putting on, go out to December of next year if you really want to start getting, I guess that's a short dated one for next year, but you could start getting protection on with the same idea. All right. Anyway, December 2022, here we go. We're looking at that $7 put. It's going to cost us around 50 cents to buy it. That's fine. I'm actually putting it into a little P&L calculator for us. Well, we don't need to do that. It's pretty straightforward. All right, so 50 cents. You turn around. What can you sell to bring in that 50 cents? Well, if you're going to a straight, a straight risk reversal spread here, look at that. The $7 put costs you 50 cents. You turn around for about that. You can buy the $8 or sell the $8 call for an even money here. Selling the $8 call in December, buying the $7 put. It's costing you just commissions and maybe a penny or so to have a floor in at $7. Now, you definitely cap your December at $8, but at 70 cent, 64 cent improvement from where you are now, to have that floor involved for little to no cost, it seems like a no-brainer. If you've got bushels and you're planning on holding it through whatever storm comes this summer, and you're not buying the $7 put and selling an $8 call to just sleep at night, I got to ask you about your marketing plan. Anyway, this is a great way of protecting any strategy where you are long exposure to a market. It doesn't matter what what asset or underlying you have. You're using risk reversal spreads like this to help finance putting in a floor and protect your bottom line is a very imperative tool that is not getting talked about enough right now. I wouldn't go out and be selling cash and forward selling aggressively. Makes no sense in this environment. In fact, it's probably going to be your biggest regret you've ever made in the 40 years you have to farm. But just my opinion. I could be totally wrong about that, but I see a better way to manage your risk, allowing you to improve to the upside while maintaining a floor that completely caps your risk to the downside in this environment. Anyway, that strategy can be even more aggressive. Spend 10 more cents, buy this 720. Still sell the $8. Maybe you don't mind spending 20 cents on this. Buy a 720 put for 60 cents, sell the 820 put for 43. 17 cents out of your pocket. You've got now almost $1.90 of upside improvement on the market on against the board. And you've now have a stop that is, or stop loss on your entire production that is just a few pennies below us at 720. Anyway, I see better ways to do a lot of what is being talked about out there, and this is one way that I think you can get that protection for yourself in the meantime. All right, let's go over the technicals for our other charts now, because I don't want to leave them in the wake. I guess since we're on a risk reversal strategy here, let's look at December beans. Is there a way to get a $15 or $14.50 floor in here for us? Let's start with that $14.50 floor for a second, and then we'll get into some technicals, I promise. I think we're going higher. Let's just put it that way in both corn and beans, in case you need to jump and don't want to watch the rest of this video, what have you. But I will show you why in a minute. But for the short term, I do want to at least show you $15 call puts. Swoo-wee, 86 cents to buy one of those right now. Well, a lot of money to shell out. 155 days of protection on a market that's been really volatile. That's what it's going to cost. I mean, that's a floor all the way down at 415. That's unreasonably expensive. Granted, that is a very tight, almost at the money option at this point, because it is between our $15 and $15.20 strike. So, but if you're upside here, if $15.80 is a sweet sale, $16 is a sweet sale, 20 cents right here of cost to you. 20 cents right now, you can basically get a floor in at $15 November beans, sell that $16 call. We go up, great. You made 85 cents on the board against that short call, and 20 of that cost you your $15 floor. Okay, and these strategies also don't have to be, certainly if you're working with somebody like myself, we wouldn't just sit in this strategy, although there'd be nothing wrong with doing that if you have the bushels that they represent and we are managing the risk on an actual stored production. Or at this point, this could be a great way to protect some of the bushels you've got in the field still, right? This strategy could also have some maintenance with it. That $15 call, as the market moves higher, could be rolled up. The $16 call, if the market goes sideways for the next 100 days, is going to lose a lot of this premium. And we can buy that call back and adjust it, maybe sell another one at that time, right? You roll the calls around. You don't have to set it and forget it over the 155 days, although if you did, for the producer, these are great strategies to put a floor in on price, afford it at a level that it's not putting up a ton of margin for the margin man. And by the way, if the market does rally, right, there is the issue of potentially having margin calls, but that is where this is a hedging protective strategy against that risk exposure you've already got. So your cash rallying, certainly if again, it would be important if you're going to use the board price here to do some kind of HTA, so that we are locking our basis at some point, or do a basis lock so that you can, have a futures reference. And then from there, now your risk is on the futures board, and it will be one-to-one with what we've got here. If you can take your basis out of the equation, lock that basis, and push that risk to the board. That is an assumption you have to do here. There's ways of doing these in the cash market as well, where if you don't like coming up with your margin requirement, that's something we can talk about. We have programs here at Zaner that allow producers that afford you that type of advantage. You don't have to then fund a futures account and do this with that. But the most effective way and the best way, the way that we can do it, in the service to offer to you is, hey, anytime we go and we lock our basis, you come and you say, hey, Dan, I just locked down another 25% of what I got in the field. Let's get a risk reversal strategy on that keeps the floor in my price and opens up the top side. And we would immediately start talking about this. Now, if you're doing forward sales at this time, no problem with that either. That's where, using call spreads or just owning a call alongside doing a forward sale, brings and opens up your upside because calls have limited risk. There's no downside beyond what you spent on them. You've already locked your cash price by doing forward contracting, and the upside on the board that the long call represents is something you can maintain on. So there's always a solution here for how to reduce the risk that you already have in the market. November beans, though, $15, a $16, 20-cent cost, kind of cool. But okay, if we bring that down to now a 50-cent cost for the 1440, a floor in there, okay, you've got to open up a little bit. But that 50-cent cost really cuts down or opens up the upside too, because now we can go all the way up to like a 1680 at an almost 7-cent cost there, right? 7 or 8 cent cost between the 1460 and the 1680. That gives you it's a $1.20 wide risk reversal spread. It gives you $2.20 wide risk reversal spread. It gives you $100.65 to the upside of potential upside you can make. And I think if any of us get the opportunity to sell just shy of $17 beans this year in November, you got to take it, at least some of it, right? 1520, 1514 is pretty good too. Don't get me wrong, but I do believe we are in the time of year where 1514 at this point in time might be one of your lower sales if you do lock it in without any time of upside reownership at this time. Okay, let's get to the technicals. That's a fun discussion about how to use options for hedging purposes. Doesn't matter if it's grain in the bin, a forward contract, a stock, gold holdings, cryptocurrencies, anything you have that is an asset exposed to risk. There's definitely a derivative option strategy to manage that risk, and I'd love to talk with you more about them. Okay, so enough of the shameless plug of what I do over here, but November beans, we'll begin here because the chart's up. 55-day moving average right around 1484. Seems to be the support in the short term. The 18-day is the level we're flirting with, and now it's closing in around that $15 mark. This is the fight over $15, and you're watching and witnessing it in November beans. You could say that the fight over July corn is the fight over $8. The fight in December corn is fight over $17.50, and the fight over July beans is the fight over maybe $16.50 or to break above $17 at this time. That's the narrative that I would say about these markets, and to me, these are all congestions and sideways price action that I assume is going to continue out of the range the same way we came in it. At this time last year, we had already, we would be crashing down to the low end and reversing all of this, the upside move. So things are different. I was certainly one of the first to point out how, last year and the year before we were peaking at this time. I was expecting us to have had that push through rally and maybe had made a top by this point, but this isn't last year. There are a lot of different things, inflation being one of them, that justified the rising cost of everything. And last year, arguably, row crops and agricultural products were the only things inflating for since 2020. We've had an inflationary market in agriculture for 2 or 3 years now. Everything else is just catching up and verifying what we are seeing and saying. And knowing that the consumer price for many of these goods in China by the end user is way higher than it is still here, I think we have a lot of upside potentially to go. All that being said, we're back above the 18-day moving average here for November beans at 1493. We held it as support today. We bounced off it. Certainly a little 3-day correction, but this looks like, very strong bull market, bull pennant flag. And if we push through the highs here today, highs of the week, highs of the month, contract highs are all right ahead of us here at 1540 to 1550, which I do believe at this time we will, barring any swift reversal lower on an option expiration Friday, which absolutely could happen. We'll see what happens. 18-day moving average solidly above it here in the July beans. 55-day moving average, both of them around 1650, breaking out above them. Higher highs, higher lows. Very little to be said about the technically bullish trend we see now on this chart. We are getting into overbought territory. The last time we hit 1.0 and overbought, we did turn sharply lower. But I I wouldn't be surprised to see us, the next couple of days push above 17, maintain that overbought condition. Then we flirt around for a couple days, overbought unwinds, and then we turn higher. At that point, we'd be pulling the 18-day moving average higher, and I would say that it's probably safe at that point to say that as long as we remain above 1660, we should be continuing higher towards 1760 and to new contract highs. That's a long way off, but let's see if we get there. 1, 2, 3, 4, 5 ways up and down inside of this range for the last for the whole year. Beans above $17, very bullish. Back below 16, get a little bearish. Anything in between has just been a chop fest. But I do believe we will continue out of this range higher. And let's take a breakdown now of the small time frame here, starting with November beans. Inside the range, we weren't holding any form of 50% retracement, although to me, this looked like an impulsive wave higher and 3 waves back. It did go down to 61.8 lines. So, my rule, I got to remove that 50% from the chart. And then you take a step back and you say, okay, well, then we're in some kind of larger correction. And yes, we are. Very big, large correction on this chart. Trendline support for November beans has pretty much held here against the lows. Which is why I see this as a very much a large long-term pennant structure that we could be starting a breakout of. Full 50% retracements of the month from 1437 lows to 1530 highs. We're at 1487 or excuse me 1484. Came within 3 cents there and got a reaction. Pretty strong reaction higher, but I am watching the 1490 to 1480 area, as support if it gets back down there. I don't necessarily think I'd be a buyer right on a second test without some kind of confirmation higher, but we do break through highs and we go through the highs of the month. You can see how this, was very quickly looking like an impulsive wave higher, corrective wave down, 1 step forward, 2 steps back. Now we start some, form of a trend higher in the near term. July beans, the driving force now, I think, going forward, as we were up 27 cents today in July beans, finally some, what I would call some normalcy is coming back, because it was weird to watch new crop be the winner over the last couple weeks and see that bear spreading in inverted markets. But even spreads have to retrace. That same trend line against the lows, and July beans did, break today, but we settled back above it. I think this was a bit of a bear trap today. It was not quite a full 50% short from the 810 low to the highs, or to 810 low to the 810 highs, down to the lows of today. We snapped all the way back, didn't quite get to the 791 level, traded 789 3/4. That's close, but 2 cents on a move that's only that wide is not enough to me constitute a filling. So talked about in the short term, we're looking at corn here. I need to go to beans. What am I doing? We already went over all of this. Trendline support in the beans, much the same way. Okay, July beans broke above that high. Man, I'm just all over the place today. Broke above their trend line here. Throwing me for a loop. Got to reassess. Still a very big range, right? 5 waves in this range. 1, 2, 3, 4, 5. Didn't break below the prior low. Yeah, this is expanding triangle, perhaps. I don't really care. It's corrective to me. It's until we get above 1720 or below, 1570. It's just a chop fest. However, inside this chop fest, we can start to look for, at least once we've, a bottom is formed and some kind of pattern, higher, routes, we can look at where that pattern might terminate from in case, a reversal starts to happen. For me now, that's below 1660, below the lows of today, below this little trend line that we're starting to hold. And certainly a break below on the 15-minute time frame, these intraday levels that are holding. Next in the series on the day actually has been holding here we gotta go down to a 5-minute chart so you can see what I'm seeing. we kind of had a blow off or breakout. So the highs here we've been flagging inside of all day. 1690 was the pullback. In the short term, so long as we're above 1688, I don't see why we'd get down to 1678, but 1678 would be the full 50% retracement from the day. We do have an open gap now down around 1673. So long as that gap remains open, so long as we remain above 1660 lows of the day, this market's trying to make progress to some extent higher. We closed the day above yesterday's highs. We flagged up there for the better part of the day. I am kind of expecting the market to make that push towards 17 tonight. Big level. If it can break through it, it's going to probably cause some pain to the shorts. And in this environment, potentially short covering rally and a gamma squeeze against, the short $17 calls or, that threshold that for the June puts or June, options that go off tomorrow. We'll see. It's been a trend higher. And the next in that series trend, let me find it for you here. Get a 50% retracement right here. That first move off the lows up to the 1626 high, we pulled back into the 1602 50% retracement. We went up to the 1638 next in the series, or the target. Next in the series after that target hit, went from lows to highs. Next in the series traded and broke out of its target at 1646. You can see how I drew from the old entry low to the new target high. This is those footsteps in the sand I talk about, 2 steps forward, 1 step back. This is the algorithm or whatever longs that in the market we're finding that we're tracking, we're trying to follow. Pull back 1621, that went to 1646 targets, up and through. Next in the series, then from there, entry low to target high, even though it broke out, it's okay. Progress, right? 2 steps forward, 1 step back into 1644. This is where then the market started trading what we refer to as a same anchor new high. There are reasons that this pullback or this triangle, this sideways consolidation might actually be what we refer to as nesting in an extended wave. And if that's the case, what the market started to do was from this high to high, and there are reasons I look for these things that I've spent years following these patterns in the market. Highs to high, 50% pullback went to target. So same anchor new high does not rule out a move down towards 1666 for the soybeans. But if you notice, the invalidation level aligns perfectly with where I talked about, and this isn't self-fulfilling prophecy. This was, we just tracked through how the market is progressing with a series of fibs and pullbacks and making 2 steps forward, 1 step back. We have trend lines that align with 1660. We have the 61.8 line. It's a good reason that if we stay above that level, the trend higher is intact, at least the trend that began from the lows, and that is progressing this market higher. Once that gives way, then we could talk about a revisit back down to the contract or the lows of the year in that range that we've been talking about. And at that point in time, if we start to go below, we can talk about, highs actually being in and what have you. So much like corn, you can finally track this. We were tracking a little higher there too. There's a reason now why a move back to 1666 is possible. Now, that means, though, that the swing from this 1656 low to high, it has the ability to hold the 50% retracement down into 1778. That's the nature of an extended Elliott wave or extended fifth wave, if you want to read about them in the Elliott wave manuals. An extended fifth wave is, I believe, what we are going into. And those extended fifth waves oftentimes become very extraordinary. They're the ones that blow out. And then, once the wave structure develops further, we might start calling that the wave 3 of 3. But it's how we get there. It's how markets go from moving 1 to 2 pips at a time or ticks at a time to moving 4 ticks at a time to moving 10 ticks at a time, right? As price expands and volatility picks up, markets are allowed to move around more. And if they're in the midst of a trend in doing so, they have to account for that, right? Each leg higher gets a little bit bigger. The first push up here we had off of a long only moved from 1604 to 1637. The next move moved from 1621 to 1667. So, growth occurred. The market started to move exponentially higher. Each leg higher is getting bigger and bigger. That's a suggestion of strength here, not of weakness, and not a reason to be looking for a top at this time. However, I still think ratcheting up your support in a way of locking in the lows and on these markets makes a lot of sense. That's where those risk reversal strategies come into play. Wheat, maybe a little bit of a double top here in Chicago, but when we look at let's bring up the other chart here. Double top here in Chicago, $12 now acting as support on a pullback after our gap up we've filled. 18-day moving average down 11.29, 55-day down around $11. I mean, we could pull all the way back to 11.50 to 11.29, be in a 50% retracement of this entire rally, and still continue higher. The volatility here is so big that, wheat's moving 20, 30, 40 cents at a time. If you're not comfortable with that kind of those swings, you do not touch wheat right now. KC July, KC July contract breaking out of its contract high, pulling back to fill that gap. Looks like back and fill price action to me. We'll take a look at here in a minute. Why I think that the pullback we just saw into 1280 might be an extended long that has targets above $14. And Minneapolis spring wheat leading the way still, down the least, usually up the most, and certainly pulling back off of its contract high here to 1330. Again, just like the KC wheat, filling its gap in a little bit of a pullback. Wow, 1246 is its... What's it called? All right, promised on the KC wheat, we would look at here why I think, the breakout we're seeing could continue higher. You see a 50% pullback here from 994 to highs. This, wedge-like structure broke out. Yeah, I think it'd be a gift if we got all the way down to like 1235 or 1225 to buy this thing, but I don't think that's the case. If you see here, I have a 50% line drawn up from the 994 low up to the $12 high in the KC wheat. The pullback here was in 3 waves down into the $11 level, 50% long, trend line support. Lots of reasons why that at that time, including a move down toward in a test of that 55-day moving average, perhaps around $11. Was the reason we pulled back. We then shot up to the negative 23.6 line at 1250, but we blew right through it, went through highs and all the way up to 1380. The highs to highs extension now is drawn from 1202 highs up to the new highs, and we just pulled back, in a kind of choppy little bear bull pennant to fill the gap right into 1290. As long as we remain above 1270 here on the KC wheat, I've got upside targets towards 1421. And those extend towards 1488 as I expect this market to continue higher. We break down there. Now we're breaking back down into, against the larger progression here that we've seen. And a retest at $12 might not be out of the way, but, our 18-day moving average is there. The 100-day or 55-day moving average would very likely be drawn up a little bit more. And we'd be retesting these, breakout levels if we come down further. If we're going to extend higher in this leg and this is going to continue to run higher, we traded support today, got a little bit of a reaction, and into the end of the week and into next week, we're going to expect to see this market continue higher. We'll see. But wheat basically in back and fill price action for the wheat off of contract highs after gapping up. This is all very much weighing, as is the equity indices, weighing on our cattle markets. August cattle down, pretty corrective, but down now below prior lows here, below 618 lines of this last swing up we had. Cattle running the risk here, breaking below 132, certainly already broken below its trend line support here on the outright August chart that we broke below before. I am concerned that you kind of got to take a step back on cattle, live cattle. See, where the continuous contract is too, and how it's breaking below channel support. We are certainly, on the chart, when you go on a larger time frame, go and look, breaking above the 130 area, all of these April highs from 2017, 2019, It's breaking above those levels and then kind of testing them support. That's basically the only reason I'm still hopeful that the cattle are going to continue higher. But if we slip below 132, 130, not much in the way that should keep us from getting back down to 120. And certainly, consider the full pullback from 76 lows up to highs here. There's no reason we couldn't pull back towards that 110 to 100 area. Not necessarily, in June cattle or August, it's going to take a while to get there, but you guys are catching my drift that, hey, cattle have come a long way. We've been in consolidation, and with the rising pressure of the input costs from our row crops, we could have might have some concern here in the near term. August feeders being the leaders to the downside here. New contract lows was not something I was anticipating or wanted to see here. Could we just get capitulation and this be forming a low? Yeah, when we take a step back on our feeder chart too, although this is the continuation charts and the feeders are kind of a joke, as you can see. You have to admit that anywhere above 150 over the last year has been pretty well supported, and any moves up towards 170 have been pretty well sold. I'm fearful that the August feeders are starting off near their highs for the contract rather than lows, and it's going to be an interesting dynamic to continue to watch them play out. In the near term, though, this does look, there's not much in the way of anything but a channel lower that I see kind of forming. Having found channel support at this time, I would not be surprised to see a move back up to 172 to 170. But there's definitely a trend line here that is capping the feeders that until we break above, I would not feel very comfortable with the long side. Just because it just keeps getting faded, and every pushback higher in corn is just going to make it harder for feeders, to continue to rally. So, all right, everybody, that's all I've got for you today. It was a big, long seminar here, 56 minutes. Hope you sat through it all. Do give me a call, 312-277-0110. Find me on Twitter, Facebook. Shoot me an email, dhussey@zaner.com. If you are interested at finding ways to put protection in because you've got a lot of it in the field or a lot in the bins right now, there is plenty to talk about and to do. That's my number on the screen. Give me a call, shoot me an email. It takes 10 minutes to set up an account and costs nothing to you to become our client and start working with us in that capacity. Then when we put something in front of you that you like and enjoy, we can have a discussion further about it. I am going to be doing a video here shortly about a new product we just launched. It's called Farmview. We were previously calling it the My Farm app. It is now Farmview app. And it is it is like QuickBooks on steroids for the farm. We take data all the way from the field and can compartmentalize and analyze it for you within that application to help you with not only tracking your production, tracking your input costs, tracking everything that could go into the field and affect your business and bottom line. And then the catcher of it all is that we bring your cash sales and statements into it alongside your futures to show you exactly where you're exposed, how you're exposed, and what then to do about it, right? So it's a tool that sheds more light into the risk management. It's a risk management solution for you and an accounting tool that pretty soon I'll be doing a video on it here before this weekend, I promise. But all that being said, everybody, thanks for joining me. Have a great weekend. Have a great day. And we'll be back with you as price action develops. Take care, everyone.